shopping for a mortgage, you've probably seen a lot of numbers and terminology thrown around. 6.25%, 6.5%, APR, points, origination fees. It can feel overwhelming fast. And here's the problem. Many buyers focus only on the interest rate without realizing that the rate doesn't tell the whole story. Today, we're breaking down the difference between interest rate and APR, the most common mortgage fees, and how to compare loan offers the right way. Let's make this simple. A mortgage interest rate is the percentage your lender charges you to borrow money. That's it. If you borrow $300,000 at a 6.5% interest rate, that percentage is used to calculate your monthly principal and interest payment. Important note, the interest rate does not include lender fees. It's strictly the cost of borrowing the money. This is the number you'll see advertised most often because it's eye-catching and easy to compare. But it's not the full picture. APR stands for Annual Percentage Rate, and this number is much more comprehensive. APR includes your interest rate, certain lender fees, discount points if you pay them, and some prepaid finance charges. Because APR includes more than just interest, it is usually higher than the advertised rate. Here's the easiest way to think about it. Interest rate equals cost of borrowing, APR equals total cost of financing. APR is designed to help you compare loan offers more accurately. If two lenders offer the same interest rate, but one charges significantly higher fees, their APR will likely be higher. And that's a red flag worth investigating. Now, let's talk about the fees that impact both your APR and your closing costs. Here are the most common ones you'll see. Origination fee. An origination fee is what the lender charges to process and create your loan. It often covers reviewing your application, pulling your credit, preparing loan documents, and funding the loan. This fee is usually around 0.5 to 1% of your loan amount. So, on a $300,000 loan, a 1% origination fee would be $3,000. Sometimes lenders advertise no origination fee loans, but it's important to look closely. That cost may be offset by a higher interest rate. Nothing is ever truly free in lending. Underwriting fee. The underwriting fee covers the cost of evaluating your loan for risk. During underwriting, your lender reviews income and employment, credit history, debt-to-income ratio, assets, and a property appraisal. The underwriter determines whether the loan meets guidelines and can be approved, thus assessing a borrower's risk. This fee is often a flat amount and included in your closing costs. Discount points. Discount points are optional and allow you to pay a dollar amount upfront to lower your interest rate. 1 point typically equals 1% of your loan amount. For example, on a $300,000 loan, 1 point would cost $3,000. In exchange, your interest rate will drop by a certain percentage. Paying points can make sense if you plan to stay in the home long enough to break even, meaning your monthly savings outweigh the upfront cost over time. But if you plan to move or refinance soon, paying points might not be worth it. Appraisal fee. Your lender requires an appraisal to confirm the home's market value. This protects both you and the lender from overpaying or overlending. This is typically paid up front or at closing. Title and closing costs. Other common costs include title search, title insurance, recording fees, settlement or attorney fees, prepaid property taxes, and prepaid homeowners insurance. Not all of these are controlled by your lender, but they do contribute to the total cost of getting your mortgage. Let's walk through a quick example. Lender A offers a 6.25% interest rate with higher origination and underwriting fees. Lender B offers a 6.5% interest rate with lower upfront fees. At first glance, Lender A looks better because the rate is lower. But when you compare APR, you'll likely discover Lender A's APR is actually higher due to those added fees. APR helps level the playing field. But here's something important. APR assumes you keep the loan for its full term. If you plan to sell or refinance in 5 years, the better loan might look different depending on how long you keep it. This is why the length of time you own the home matters just as much as the numbers. When reviewing a loan estimate, ask, what is the interest rate? What is the APR? Are there origination or underwriting fees? Am I paying discount points? How long does it take to break even on those points? What are my total closing costs? A trustworthy lender should be willing to walk you through every line item, clearly and without pressure. Transparency matters. A low interest rate looks great on paper, but it doesn't always mean the loan is less expensive. Understanding the difference between interest rate and APR and knowing what fees are included helps you, the borrower, compare lenders confidently, avoid surprises at closing, and helps you make a decision that is aligned with your financial goals. Buying a home is one of the largest financial commitments you'll ever make. The more you understand the numbers, the more confident you'll feel with the process. If you have questions about mortgage rates, fees, or how to compare loan offers, our home loan team is here to help. If you found this video helpful, make sure to like, subscribe, and leave your questions in the comments below. We'd love to answer them in a future video. Thank you for watching.